Okay, we are live. Thank you guys for listening and dropping in. We're actually just kind of putting some content out there regarding seller financing notes, since majority of the people are listening are in the seller financing group, seller financing homes, but we're also going out to different platforms within the social media world. So we have David on. David is a note buyer, and Dave, thanks so much for coming on. I appreciate it. And so, why don't you kind of introduce yourself a little bit?
Sure, I'm Dave Putz from JKP Holdings. I'm a note buyer for over 13 years now, and I primarily bought bank originated notes for the longest time. And I got into the owner finance world a couple of years ago, and I found it very fascinating. The worlds are two different separate ones, but I started out with buying bank loan assets for a hedge fund, and I started transitioning to my own company buying notes nationwide.
Whoops. That's awesome. So you got everything dialed in. But for today, what we really want to get into is like how when we do create seller financing notes and we're selling it into the secondary market, how we can get premium for that particular note, because I know there's a lot of different things that kind of go into it where you guys look at. So what is like one of the first things that you guys look at? Like if I'm bringing a note and I just did a seller financing transaction with me and my end buyer, and I wrap it or whatever it may be, and I'm coming to you, like what are some of the things that you actually look at, so I can try to get premium dollar when I sell you my note?
Sure. There's a couple of key ones, right? One of the key ones is your interest rate. If you're doing it at 8% or 5% interest rate, you're not going to get the premium dollar, right? You can't be coming to me. I don't care what the UPB is or whatnot, but if you're writing really low interest loans, the fact is I'd have to discount a lot because we target yield. So if we're sitting there at a 12, 11, 10 yield, your discount will be a whole lot less than if you price it at 5 or 6 or 7 or 8. The next factor is your term. If you have a 30-year term versus a 15-year term, our numbers can be again discounted a little bit less because of the fact that it takes us less time to get our money back. Those are two, when we call it note math world, are the two biggest factors because they drive the whole note. We're buying an IOU, we're buying a bond per se, and the interest rate and the term drive all the other forces. If there's a balloon, it also impacts it. But if you're sitting there with a 30-year, 5-year interest rate loan, we can't sit there and buy that loan at a without discounting it a lot because we need to make sure we hit our yield numbers. Another big factor, and I'm sure we'll get into it, is the collateral file, right? Excuse me, the collateral file is a huge factor for us. In the bank world, we want to make sure the chain is connected, meaning is the original seller to the next person who bought it transferred over correctly. In the owner finance world, that shifts a little bit, right? Because the original creator was usually a bank who's regulated and whatnot. When you deal with the owner finance world, it's kind of like the backyard fun of doing notes, right? Sometimes it's kind of on the whim or whatnot. But unfortunately, what we're finding now is a lot of people doing this stuff just don't know the repercussions of doing it, the paperwork and the collateral file correctly. And that's where a lot of the issues we're coming across in the note world because we've been through non-performing and court situations and legal factors that some of these investors may have not gone through yet.
Nice. So I want to back up a little bit, for people that don't know this. Like, dive in a little bit about the yield, like what you're referring to. Like, how do you determine where the yield is? Because a year ago, the interest rates were much lower compared to where they're at today. So, how do you guys look at that as a yield? So, kind of educate the
Sure.
listeners in a little bit.
Yield is a mathematical formula. Just return to what is the annual return on the interest a year. There's a financial calculators. We also have a financial calculator on our website to figure out the annual return we're going to have. The yield number is a mathematical formula taking apart the interest rate, right, plus your term, plus any balloon, and putting it together and figuring out what the annual return will be. And that number determines what our return is a year, our interest number, right? Our principal doesn't matter. It will drive the interest. The interest is what our return is, our profit is on the deal. We're going to get partial principal, partial interest based on the amortization schedule. When we work with amortization schedule, it shows principal and interest payments. Well, guess what? That principal payment is just giving back the UPB part. The other part is the actual interest on the loan. Now, a 5% loan will drive that payment down. I get that. However, for us to get a 10, 12, 15% return, annual return yield number, we get a discount, say we have a 5. To get that up to, say, a 10 or 12, because of we 5% to get it up, we have to dramatically price that balance of loan a lot lower to get it back up. If you compare a 10% loan at 50,000 versus a 5% loan at 50,000, you'll see a big difference in the payment amount. And the return is 5%, and the other return is 10. So yield is a big factor for us buying performing notes. We're not even touching upon the fact that if it's not performing, which state it's in. Because states make a huge factor when it defaults.
Got it. Now, you mentioned something about you also performing and non-performing notes. How does that play into when you guys are buying notes? Because I do know you also buy notes that are not performing as well, if I
Sure.
recall.
Absolutely. So non-performing really means the fact that the borrower is defaulted more than 90 days. Before 90 days, they're still quote unquote performing. We can't make any kind of default or foreclosure processes. When we're buying a performing note, we know the fact the borrower is on board with us. However, when the borrower defaults, which we have no problem dealing with, we got to go through a legal channel of starting a foreclosure. The borrower may reinstate. However, when we make an offer on any of these assets, we literally have to turn around and say, listen, we want to buy this note. However, if this thing defaults, what is our risk level on this?
Got it. That totally makes sense. Now, there's a Facebook user who's kind of plugging some stuff in here, and thank you. I don't know who it is because it's not showing the name, but they're kind of saying, hey, the structure, the borrower you guys look at, the collateral, and then this part I definitely we want to get into in a minute here, and this is where, the paperwork and compliance. And this is what we're seeing a lot right now, where a lot of people creating seller financing notes are not in compliance. And let's talk a little bit about that because how does that affect, if I have a file and I will bring to you and I want to sell it to you, but I don't have the proper paperwork and it's not compliance, how does that affect you buying my
Sure.
note?
Sure. We'll be having a webinar on this topic in just about a week from now, a week from Friday, next Friday. So the paper compliance, if we're not worrying about the trailing of documents and who bought it, who sold it, we're worrying more about the fact that this loan has been compliantly written. The origination has to be compliant. What does that mean? Well, when you originate a note, there's the FEPC that comes on here and regulates and says this is a legitimate origination note. If it's not originated correctly, the borrower has a lot of rules and regulations that protects them. Now, when you create a note, you have to make sure the borrower Dodd-Frank laws has the ability to repay on that note. And also the fact that the note is written to the state regulations, that the interest rate's not too high and things like that. The borrower's repayment as well as the loan document numbers. When we go to buy something like this and the paperwork is not accurately written, we run into huge issues. What do I mean by that? Well, if the loan defaults, the judge, the attorneys, and everyone else involved can come at us and say this paperwork is not written. The borrower may not have to make that payment, right? They may be defaulted, but then there's a penalty on the origination person where they can actually lose and have to repay back the borrower all the interest they've collected over the years. If they're not origination, if they've done more than 3 years, they actually have to have a license or use an RMLO. And if they haven't underwritten the borrower, prove that the borrower can repay that loan, they're actually failing that compliance as well, which causes even more issues. So we want to make sure that we may not have to deal with a judge or compliance, but if that borrower fights and puts a fight up the fact that they didn't have the ability to repay, and a checkbook written on 20 grand, 20% down is not doing underwriting. If they don't do those kind of things, the borrower can go and contest the loan and say you took your predatory lending to us and we're victims of the situation. So it's a huge market that we're finding a lot of these owner finance, seller finance, or even wrap creators are not doing for compliance reason and putting this loan in a huge jeopardy, not just to sell it, but for your own company. You have to pay back the interest to that borrower in full if you don't have an RMLO, an underwriter, and an owner-occupied property.
actually want to piggyback off that a little bit. So, just so you guys know what an RMLO is, residential mortgage loan originator. So, or officer, either or. But you guys need to make sure that are listening. Again, it's who you're when you're putting somebody into the property that's going to be living there as their primary residence. Then there's a lot of consumer protection regulations, and that's where you guys are talking about compliance here. And I see a lot of people out there putting deals together, and they're just doing assignments. You are technically originating that file, even if you're doing an assignment. So if that loan goes bad and they can test it, you're going to get pulled into it. So you want to make sure that if you're bringing a buyer and seller together and you're doing an assignment, you want to make sure that you're, besides you looking for that assignment fee, you want to make sure that you're using an RMLO to make sure they can qualify to protect yourself so you didn't get pulled into it. Because you could be considered as a primary, a predatory lender on that.
Absolutely.
So how does that affect the pricing? Like if you're going to buy that, like
So
how do you look at that?
if that loan is sitting there originated by someone with the underwriting is involved with the checkbook only, we're literally going to do one of two things. One, run like the hills. We're never going to touch that loan. We can't touch it, but we're going to help you fix it, right? And what that means is you have to work with the borrower to convert that over and make sure that they will pass underwriting. Other than that, we won't touch that loan. Why? We cannot take the liability and the risk of that situation as the originator did. Maybe not been purposeful, maybe lack of education, but that's what we're kind of doing these things is to teach them that if they're doing things like this, we're going to run like the hills unless you're able and willing to work with your borrower and get them to repay or re-originate the loan, right? Mortgage, if you're going to do a mortgage or if you're going to do a contract or deed, land contract, or whatever, but you have to underwrite either scenario has to be underwritten for the fact that that borrower has the ability to repay and you're not just pulling the wool over someone's eyes.
Right. And anybody listening, if you ever run into that situation where you didn't do the proper compliance, and you have your end buyer stop paying, reach out because I do buy those type of, and I think David does as well. We'll look at that and buy those from you and kind of resolve it. It's going to be at a great discount because it wasn't done properly with compliance, but we will look at that
Yeah, absolutely.
and analyze it, see how we could help you out and get at that situation. But let's get back to the notes a little bit more
Yeah.
of, you know, what do you look at? How long do you normally, when you buy a note, how long do you normally hold that note for? And what's your ultimate goal? Like, what do you look for a certain yield? Like, what do you look for that? Like
Sure.
we
So
as, go ahead.
we target some. We used to target yield so much. We usually target now IRR or what we call NPV, net present value. So we're targeting a return a year. We yield is a number from today to maturity date, the bond formula, right? And we don't predict the fact that we're going to hold a loan for 20 years. We don't assume that. Most loans last between 3 to 7 years, depending on the borrower. They may sell the property, they may default and foreclose. We may decide to sell the property. So we bid on the fact that we may hold for 2 years, 3 years, or 5 years. We could go to 7, but we typically go that range. And we say, okay, we want this typical IRR during that time period. And then we would sell the loan possibly at a yield number of say 10, 12% on the back end at times. However, we target numbers. If we want to use a yield number, we're looking now at the fact that prime's around 7.5, 8 right now. It's very high. So cost of capital is extremely high up now. We're a year ago, we're getting capital 5, 6, 7. Now we're up at 8 to 10. It's getting extremely expensive. So our target now is getting up to 15, 16, 17. If you newly originating, you just look for table funding, we're getting up to the 17, 18 because of the risk level. We call seasoning, where if the loan is originating today, for us to buy it, there's a highest risk for default. So we look typically for 3 months of seasoning. However, if we're going to buy something right off the table, we're going to look for a much higher yield, which means a bigger discount on my purchase price because of the risk level per se. So we're looking around between a 15 and 18. If it's newly originated, we're looking at a 16 to 19 usually. And if it's a first lien versus second, that's another price difference, right? A first lien is the numbers I was given before, 15 to 18, 16, 19. Where second, we're looking at more 18 plus because of the fact that the seconds have to do with equity and things like that, right? So if there's no equity, then the second's priced lower because the risk level losing a balance of a loan. Where if there's protection of equity and it's performing, then it's priced better, which means less of a discount. we're looking around 18 still for that, where just a year ago it was a lot less, but you have to understand cost of capital's changed. We're really in the banking world as note buyers.
Now, when you say table funding, what does that mean? Does that mean like, well, I'll let you answer, then I'm going to kind of jump
Yeah,
on the back of
absolutely.
that.
So what we call table funding is that you created a note today and you're looking to sell that note as soon as possible, right? It's literally you originate it, you want to sell the note and get rid of it, which is fine. However, that borrower hasn't made any payments yet, right? So we don't know if that borrower is going to perform. You have no track record. It's similar to a performing rental. If that property was performing, you're going to get better pricing if you went to sell a performing rental. If it's a new tenant, the risk level is high, right? So we have that kind of regulations, and that's what I consider table funding, is that we're going to give you money basically as soon as you close that note, and we're going to buy either partial or the whole thing. Is for another conversation.
Got it. So in a sense, you're saying that if I'm buying a property from a seller, let's say it's, $300,000, that the ARV or the value is that's what you look at. And if I brought another investor and just to close on it from the seller, with a note, you guys will go ahead and table fund and buy that note like immediately, like that day or the next day, in a sense.
Yeah,
That's what you're saying.
yeah, absolutely. We'll buy them pretty quickly if we can get numbers. But again, that's the biggest discount you're going to take in the entire process because it's newly originated.
So what do you normally look at? What kind of seasoning do what you guys
We're,
prefer?
yeah, prefer 3 to 6 months. Right now, we're looking at that 3 to 6 month be our target right now. But we're not hard and fast. It really has to do with the property and the borrower. If that property is worth a lot and there's equity protection, we'll probably come down a little bit. So the LTV comes into play. We don't know where property is going to be in, say, 6 months. So LTV is more of a factor right now than anything else um, to impact that factor.
Got it. That totally makes sense. So what about like somebody, and I don't know if this can help them at all. If say somebody's out there doing, the fix and flips, right? And they use hard money loans, but now they can't sell that property. Is there a way that they could structure that? Because you know me, I like doing creative stuff, and we haven't talked about this. While we're having this discussion, this is kind of coming into my mind right now. Like,
Sure.
is there a way like they could go out there and, borrow the money from, Uncle Billy or whatever and pay that off and then turn around and then you guys would buy that note so that Uncle Billy gets his money back. Can that
Sure.
possibly be done?
Sure, absolutely. We don't originate notes, right? Um, for the most part, unless we REO and stuff like that. But most time we're not originating the notes; we're buying notes. So if Uncle Billy originated correctly and he funded the whole deal, we could definitely buy that originating note if it's done correctly. And understand the fact that when you deal with investors, that changes the rules of Dodd-Frank, and that they don't need to actually be underwritten the ability to repay kind of thing. But we then look at the fact that that investor and that borrower, how is their relationship, how is the collateral file written, and you got to make sure the note's written correctly. You have to make sure that the P&I is correct and the tax insurance are stated to adjust, and it's not part of the PITI. That you have to make sure things like if you can include the cost of servicing, that's another big factor because then we don't have to net that out of the payment. So making sure that the actual agreement between the two parties, the first payment date, the term of the note, the interest rate, everything's spelled out with the agreement between the two parties is there in that paperwork. Then we definitely could buy that note if someone creates it with their uncle or whatnot.
No, that's great. That's good stuff. So I like that. So David, how can people reach out to you if they have any
Sure.
questions, if they have a note or if they want to sell you a note? How can people
Absolutely.
reach out to you?
You can definitely go to jkpholdings.com slash sell my mortgage note. There's a click there. We also have webinars. And then when our webinars are run through LinkedIn, Facebook, you can definitely go to our website and contact us that way. Or you can just email us through our website. Mine's dputz at jkpholdings.com. Or we have our trade desk. We have assets we buy. We have assets we sell. All kinds of different things, tools, resources. We have due diligence portal for property data, all that good stuff. But if you have an asset that you're looking to sell, go to our website, give us all the details on it, and then we'll provide you a bid offer within 24 hours typically.
Right. Well, David, I appreciate you staying on. getting this information out there. We're going to go ahead and end this. If you don't mind staying on, David, for a moment, that'd be greatly
Not a
appreciated.
problem.
For anybody that's listening to this and doing any pre-recordings, and you're listening to this late at night, if you have any questions, just leave the comments below, and I'm sure David will or myself will jump in there and answer any questions on that. So thank you guys all so much. And again, follow David or myself. We're always putting content out there for more about note buying and also learning how to get into doing real estate investing and doing seller financing as
So we
well.
look
So thank
so
you
for
everybody
everyone
so
to join
much.
us at the webinar next Friday. Enjoy, guys.
Repeat that again, David.
And I hope to see everybody during our webinar next weekend about the RMLO and underwriting on our Facebook page next weekend.
And what date is that?
That's May 5th at 12 o'clock Eastern through our Facebook page and LinkedIn page. We'll be streaming live.
Yeah, I think that's huge, you guys. If you're going to be selling properties to somebody in there as a primary residence, to kind of learn and educate yourself on that. Now, again, you can sell it to another investor, and then you're exempt from all those things. But also, it's good so you're informed about what needs to be done if you're doing these, sub twos, wrapping, agreement for
Everything.
deed,
You have to
contract for
understand what
deed.
they do, what their role is, and when you need them, when you don't need them, because it's legality.
Perfect. David, thanks so much. I
Thank you,
appreciate it.
Mark. Appreciate it.
Take care for everybody listening.